Hello and welcome to the week ahead for the week starting Monday, the 26th of February. I want to take you through some of the key events to be looking out for on the economic front and what markets might be impacted and what we might want to trade around for the forthcoming week. Of course, we're exiting a week that had a big focus on earnings, in particular with Nvidia managing to absolutely smash expectations, lifting all three major US indices into record highs. But with over 85% of the S&P 500 having reported, the importance of economic data really is likely to grow as we move throughout the coming weeks. Let me give you an idea of some of the major events that we're looking at for the week before we look into the nitty gritty. This is an overview of the sort of big ticket items. You can see here on Tuesday, things get going with the GfK consumer confidence reading out of Germany, the durable goods numbers out of the US. Wednesday, we see the second estimate of the GDP figure from the US. Thursday, we see inflation start to gather momentum in Europe with Germany, but a number of the other economies, and that then leads into Friday's Eurozone inflation number. Thursday also sees that Canadian GDP reading, the core PCE price index over in the US, and personal spending, personal income. And then, like I said, on Friday, we see that inflation gauge for the Eurozone. We also see manufacturing PMIs across the likes of China, but also that ISM number coming out of the US. So let's look to the first topic, and that is the US. We have a whole host of data points being released. That Tuesday core durable goods number is going to be particularly important. Look, ultimately, if we're looking in terms of the perspective of economic health for the US economy, core durable goods does represent a key part of that. It's interesting to note that, whilst we're looking at a forecast here of minus 2.9, so a significant slump in January, that could essentially be just taken as a positive by markets because they think they might fast track the Federal Reserve to step in and start easing interest rates. So the whole bad news is good news thing does still remain prevalent as we look ahead to these reports. Consumer confidence, GDP numbers, I don't think we're going to see huge amounts of numbers around, a huge amount of movement around it. But I would say probably the key thing I'm going to be looking out for is this core PCE price index metric. Now, if we look at CPI, both on the headline and the core readings, it's very unlikely we're going to get back down to that 2% target or near it in the near future. And so really the hopes of markets in terms of monetary policy really rest on this core PCE price index metric. As long as we continue to track around 0.2, 0.3 on a month-on-month basis for this core PCE number, then it puts us on track to be able to hit that 2% target before the midway point of this year. It's likely we're going to see core PCE hit target before those CPI metrics. And that provides the basis for the Federal Reserve to be able to cut interest rates. So that's why that inflation gauge, despite it probably being followed to a lesser degree than the CPI numbers, could arguably be more important. So 0.3 expected, that's relatively good news if we did see that. But ideally, we would see a metric below that 0.2, like last time. If we saw that, that would be good for markets. So between sort of weaker durable goods numbers and the possibility of sort of low monthly inflation numbers at that core PCE numbers, this could be good for equity markets. And so that brings me on to the first market in question, and this is the S&P 500. I'm just going to pop this into full screen. And so what we're looking at here, obviously, is this rampant rally for this stock, for this index. And coming off the back of this Nvidia announcement that has essentially reinvigorated the tech sector once again, we've seen the S&P 500 push into a record high. If we look at the 4-hour chart, what we can see here is a highly trending market, but it's a beautiful one at that because we have been seeing pullbacks. But each of those pullbacks essentially just represents a buying opportunity, really. I mean, I'm trying to see if there's a decent trend line. There isn't, quite frankly. But the trend lines are less important. What we're looking at here is a market that is retracing each time. So let's see, this retracement is going to be more like a 50%, I believe. So yeah, we've got a 50% retracement there. These are all going to be relatively shallow retracements here. So we got the 38.2 retracement on this occasion. Again, sort of mid-size. So that's maybe a 50% retracement. 61.8. Let's grab that. 61.8. Absolutely perfectly on that one. This one's 38.2. So we can get rid of these two. The more recent one is a deep one. So we're looking at a potential 76.4. Let's eyeball it. Slap bang on it. There you go. So all in all, you're looking at a market that is highly trending. So let's just see what that was. That was a 50%. So we're looking at a market that's highly trending, but does give you opportunities. Depends on your strategy, the way that you look at these markets. But if you're looking for a trending market, which is generally what I would recommend, you should look for a market that is being reliable and consistent. This is a reliable and consistent index. Each time you see a pullback, as we've seen over the course of the past week, it does seem to provide us with a new higher low before we push into new highs once again. That's exactly how it has played out. I think the core PCE number, the core durable goods numbers, they give us potential grounds for volatility. Of course, earnings continue to play a key role within that. But be aware of this picture, because the near-term trajectory and the sort of short-term trajectory over the course of 2024 on this 4-hour chart has been remarkably consistent. So don't get too caught up in the weeds of it. Sometimes you can sort of get caught trading a lot of chop on the sort of shorter time frames. Always be able to look a little bit further out and try and find the time frame where it all makes sense. And I would say on this occasion, it's the 4-hour chart. So if we break down towards the downside, then it would look like another retracement unless we break this recent swing low of 49.45. Until that level breaks, the bullish trend remains in play here for the S&P 500. Next, I wanted to talk to you about the Eurozone. And essentially, we've got a host of reports coming out, but the main theme really is going to be inflation. And that's because on Friday, we see the Eurozone inflation gauge coming out. I have kept in just the German numbers on Thursday, but there's other countries as well, the likes of France and Spain, coming out with their inflation numbers on Thursday as well. So we kick off the week with Christine Lagarde. That gives a possibility of some volatility. Bear in mind, we've just come off the back of some pretty worrying numbers out of Germany. We saw manufacturing PMI collapse essentially. Then we saw a reiteration of that minus 0.3 GDP reading from Germany in Q4. So from a German perspective, things are concerning. We're expecting to see unemployment move higher once again. Forecasts around retail sales will be interesting, whether they come true, whether we move back into positive growth for German retail sales, because we've come off the back of 2 monthly declines. So if we saw another negative reading, then we'd see concerns around the German consumer, concerns around the German jobs market, and then the inflation gauge, where we're expecting, or markets are expecting, a 0.6 reading. So that's not great. So if you're looking at that year-on-year figure, 2.7 on the German number, maybe markets will concentrate on that. But if we did see a 0.6 reading, that wouldn't be good news, quite frankly, in terms of the disinflation pathway, in part because of the fact that, look, if you look at 0.6%, we're hoping to get back down to that 2% number, right? And so 0.6% in a single month means that it only takes, 3 of those to get near enough at target, whereas there's 12 months in a year, in case you hadn't noticed. So that wouldn't be great, but nonetheless, markets a lot of the time do just focus on that headline number. So it's important to understand the underlying metrics alongside it. But Friday is going to be the key one. You're likely to see those numbers on Thursday, whether it's the German, the French, the Spanish. You'll look across those major economies and see how inflation is moving for that. That's going to give you a good idea of exactly how Friday's number is going to come out. Let's say, for instance, German month-on-month drops. The German month-on-month comes in at 0.2 instead of 0.6, and we see the Spanish and the French doing a similar kind of thing. You'll know that market expectations for the Eurozone number are probably off. and it's probably going to come in lower than expected. So you do often see greater volatility or significant volatility on those Thursday numbers because of the implications it has for the Eurozone figures. In terms of the Eurozone numbers, we're expecting to see downside across both core and headline, but really I pay equal attention to those monthly numbers. We don't want to see big monthly numbers. You know, if we saw last time around, we're looking at minus 0.4%. You know, we're looking like we're going to rebound and in part just trying to balance out that weakness from the prior month. But if we see a lower than expected monthly figure, that really gives me greater confidence that we are going to see a return to target sooner. And that would be good for equities and bad for the euro. Bear in mind that we're looking at a DAX that has been hitting record highs on a weekly basis at the moment. So let's get the DAX up. This is the long term. This is the weekly time frame. And you can see here, the trend is your friend. And it's been pretty friendly of late for any bulls that are trading the DAX. It's weakening a little bit towards the weekend, but, you know, ultimately the trend is what it is. You know, you see a rally, it hits a new high, and then it pulls back over the course of half a day, maybe longer. And then it just seems to just push onwards and upwards once again. So the weakness we're seeing at the moment could ultimately be a good thing as long as we remain above the 17018. And in which case, any pullback into this area looks like another retracement or a breather within a bullish trend before this market attempts to push onwards and upwards once again. Keep an eye out for those inflation numbers. Continued downside in inflation is going to be good news for this market. But if we did see a higher than expected reading for inflation, that would potentially put a bit of a dampener on the DAX for near term. But like I said, that could essentially just create a better setup for this market. But the trend remains very bullish for the DAX. And, you know, I think that you would get some people that might look at markets and say, well, you know, of course, this market's going to go up. It doesn't take a genius to say that the DAX is going to go up or to call that. But, you know, that's the name of the game in my mind. If you're looking to trade, I would say try to find the things that are most predictable, most reliable, that happen over and over and over again, and expect the same thing to happen. You know, you might be wrong, but at least you're essentially looking towards a horse that's won 7 in a row and hoping for an 8th, rather than something that you don't know what it's going to be on one day to the next. So certainly this is a key market to be watching out for, much like US markets, both doing particularly well of late. So pullbacks for bulls within the equity markets, in particular over in Germany, the likes of the US markets have been doing very well. And I would expect any pullback to be met by further buying pressure if we see that come to the fore. And finally, I wanted to talk to you about New Zealand. And essentially, this is something that I've done a standalone video on because I thought that we were going to see a lead up to this announcement with strength for the New Zealand dollar. And that has been playing out. And look, we're looking towards a rate decision where markets are by and large expecting them to keep rates steady. However, we have been seeing some calls for an interest rate hike this time around, and potentially another hike in April. That's what ANZ have been coming out with. You know, that seems unlikely, and markets certainly aren't pricing that at the moment. But the way that I see it is there's a possibility of it. There's still a possibility. I think markets are pricing like a third chance that we're going to see a rate hike this time. But that stands them in a very different position to their peers. And so if we see them coming out with commentary around this RBNZ rate decision that would talk about the possibility of a rate hike next month or a relatively hawkish stance, then I think there's a good chance that we do see further upside for the New Zealand dollar. Taking the fact that I was talking about the euro and about the European area, but just looking at the DAX, I thought it'd be an interesting one to look at the euro against the New Zealand dollar, in part because of the fact that I've also already recently been talking about the Australian dollar against the New Zealand dollar, which I think is a very interesting one as well. So I was tied between the two. I thought I would go for Euro Kiwi on this time around. And let's see here. So firstly, we're looking at the European Central Bank, which already has a lower interest rate and looks very likely to cut interest rates before the RBNZ. And we're looking at a market where it has got room to go into because we've seen an uptrend throughout the last year. Throughout 2023, Euro Kiwi has been gaining ground. Now look at, we've got this big double top formation. The latest rally is now faltering or faltered, and we're heading back down towards the prior lows that we have here, 173.8 kind of area. Anyway, so we haven't reached that. So that means that there's still room for maneuver before we get into this major support level. And I think there's a good chance that we're going to top out here. So I think there's a good chance that we do see further downside to come. That's exactly how it has played out. I mean, obviously, I've been prepping the slides and everything for this, and it's already playing out. But that doesn't necessarily mean that all hope is lost. But essentially what we're looking at here, sorry, let me just put this on a bigger screen. Essentially what you're looking at here on the hourly time frame is a rally back up into trendline resistance. And then, 3 candles later, we've eradicated all of that gain and selling off in a very meaningful manner once again. So the bears are in charge for this market. Near-term pops, as we have seen here, sort of early part of the day on Friday, being sold into very swiftly. So, you're talking about like what time frames to be trading on. Well, this is the hourly time frame. We have got a very clear-cut trend in play here. And, if we break up through the more recent swing high through trendline resistance, then it looks like we're going to see a wider retracement. But I think ultimately you're looking at a market that has been trending very well towards the downside. We're still a decent bit away from that support level. So I think over the hourly time frame, there's probably going to be more opportunities to come as we gear up for an RBNZ rate decision that could see a rate hike. And if not, because that's not what markets are expecting. If not, we could see a hawkish tone to allude to the potential for rate hikes. That would stand them in very different stead to the likes of the ECB. And therefore, you're looking for the potential for downside coming into play for Euro Kiwi, which would align with the trend that has been playing out over the course of the last month. And we're looking for that to be feeding into a potential topping pattern here that has been generated over the past 5 months, something like that. So this all does piece together, and part of it's going to come down to what the RBNZ say on Wednesday. Of course, it's overnight, so it's not something I'm going to be looking at live, but certainly it is something because of the idea that we could see a rate hike. It's the kind of thing that we could see moves coming into that announcement as traders essentially start to look at it and think, well, we could actually see them move in the complete opposite direction from pretty much every other central bank out there. And that's caused enough for people to start seeing upside and start seeing interest in buying the New Zealand dollar. So I think that's going to be a really interesting one. Bear in mind, I've created this other video. It's a standalone piece just for that RBNZ rate decision, where I look across a number of markets against the Kiwi dollar. So if you're interested in this, take a look at that one as well. And that should give you even more markets and charts to be looking out for when it comes to the Kiwi dollar.